Welcome back, everybody, to Volatility Trading Strategies. So you won't have to have watched too many of my videos before you realize that my work does focus heavily on risk management. And my top priority in my investing is always keeping drawdowns to a minimum. I always say we don't chase big gains. Instead, we focus on keeping drawdowns manageable so that emotionally, investors can keep their stress levels down and then stay the course long term. But what I want to show you today with a real example from my own portfolio is that reducing portfolio drawdowns is actually the best way to get those big gains long term. Essentially, the best offense is a good defense. This is something that's often difficult for investors to understand, because when you look out into the social media world, on Twitter, on YouTube, when you listen to people talk about performance, it's nearly always look at my profit. Look how much we made this month or this year. And conveniently, they never talk about all the times they lose just as much or more. The vast majority of everything we see out there is about offense. What you don't often hear is, look at how low my drawdowns are. Look at how boring and consistent I am. That stuff obviously doesn't sell from a marketing perspective, but again, it is by far the best way for us to achieve our long-term goals, and that's what I want to show you. So as always, the best way to support my work is just to smash that like button on the video. And please share it with somebody you might think may need to hear this message as well. So first, we'll talk about why mathematically, reducing drawdowns is the most important aspect, and then I'll get into the example shortly. This chart is showing how much of a return is required to get out of drawdowns of certain magnitudes. So for example, if an investor suffers a 20% drawdown, it takes a 25% rate of return to get back to break even. If they suffer a 50% drawdown, it takes a full 100% subsequent rate of return just to get back to where they started. And further than that, it starts to get very grim indeed. An 80% drawdown, which many of those big gains type of traders do suffer from time to time, well, for that you're talking about a 400% rate of return afterwards just to reach that previous high watermark. So if an investor does want to keep moving their portfolio upwards, it strikes me as rather obvious that the number one priority should be risk management, so that we're not spending too much of our time just spinning our wheels in drawdowns. I officially launched the VTS portfolio in January 2012, so it's been 9.5 years now. And there's been several market crashes along the way. With a nearly 20% annual rate of return, you may be tempted to think the outperformance comes from crushing our benchmarks in good times, big months and big years. And sure, we've had a few good stretches, but actually that's not where the majority of the outperformance is coming from. You can see here, these are the top 7 largest drawdowns my portfolio has suffered since inception. The largest one was all the way back in May of 2012 at minus 7.7%. Now, if you've been trading volatility ETPs for as long as I have, you may remember that period. The old and now terminated XIV, it actually dropped about 35% for those few weeks, all the while the VIX futures term structure was still in contango. It was a strange period. Maybe I'll make a video on that bizarre month in the future. But that month 9 years ago was my largest drawdown. Since then, we've kept things to a very manageable level. But the point of this video, and what I want to make clear, is that my nearly 20% annualized return is not the result of taking on excessive risk and chasing big gains. It's actually because we've spent very little time in drawdowns, and we just focus on making small, consistent progress over time that really does start to add up. Losses are more costly than gains are beneficial, and it amplifies exponentially. The larger the drawdown, the longer the investor will be spinning their wheels. So if we can stay in those low ranges most of the time, that's not going to interfere with our forward progress. This graphic here is showing all of these top 7 largest drawdowns I suffered and how long it took us to get back to the break-even point. You can see that for 5 of them, it was 1 month later and then we were back in positive territory again. One of them recently in January 2012 was 3 months. Now, it was actually 2 months and 1 day. On the first of the new month, we actually crossed back into the positive side, but these are all showing bi-monthly, so officially it was 3 months. The only one that was really frustrating was back in 2017, after we got hit with that volatility spike in August. It took 7 months for me to reach the break-even. Now, in fairness, it was a low single-digit drawdown, so it's not like it was stressful, but it is an example of losing 7 months spinning wheels. And obviously, investors want to keep those to a minimum. We've seen several medium-sized market crashes in the last 10 years that cause investors to lose months, and in some cases, years of their timeline. And this is time that you just can't afford, because in the United States, the average recession cycle is 6 to 7 years. And let's not forget what happened in the financial crisis. That wasn't actually that long ago. It's hard to know what would have happened if we hadn't injected several $1 trillion into the economy in 2020. Maybe we would have followed a similar path, but 2008 is a good example of how punishing drawdowns can be for investors. This is the financial crisis, and right there is the high the S&P 500 made on October 9th, 2007. Well, it didn't get back to that point until the end of March in 2013. That's 5.5 years with no progress for the stock market. And that's a proxy of what also happens to aggressive investors who aren't hyper-focused on drawdown reduction. They can take years off their timeline. Because the Fed's been strongly bailing out the market in the last several years, unfortunately a lot of investors out there just aren't aware of how much time can be lost due to excessive drawdowns. They're getting very used to the markets just bouncing back and recovering very quickly. But if they thought the 5.5 years that it took to recover from the financial crisis was bad, let's drag that back a little further. Here's the financial crisis in 2008. And this is the crisis during the dot-com bust in 2000. So actually, the previous high that was reached in March of 2000 took over 13 years to get back to break even. Well over a decade just to get back what was lost. If we let recency bias affect things, we might think the stock market is crushing it right now. We're at all-time highs, everything's great. And a lot of people like to reference the S&P 500 as good performance. But let's be honest, it spent over 13 of the last 20 years in a drawdown. 2/3 of the time just clawing back what was previously lost. Hopefully now it's obvious why I say the most important thing is reducing drawdowns. Unfortunately, it's not what people focus on until it's too late and they lose significant chunks of their timeline. For me personally, that's how I plan to keep crushing the market long term. By always keeping in mind that losses are more costly than gains are beneficial, and the best offense is always a good defense. The best way to crush the market and to get those annualized return numbers that we all want long term is to spend as little time as possible spinning our wheels in drawdowns. So if you want to see how I personally accomplish this, you can head on over to my website. There's a free trial on there. You can check out some of our live trades and see if the VTS community is right for you. You're always welcome to join us. See you next time. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.